G'day, folks. I've made some statements believing that the Canadian banks, these dividend stocks, are a buying opportunity of a lifetime right now, especially now that we're seeing earnings fall in line with my personal expectations. And I want to break those down in this video as we recently got some new bank earnings out of BMO and, of course, Bank of Nova Scotia. At the latter half of this week, we're also going to be talking about Royal Bank and Toronto Dominion Bank, so consider subscribing for those updates because in the past, we already updated you on Canadian Imperial Bank, which actually did pretty good from an EPS standpoint. The stock actually did rebound off some of the lows from its earnings, which was nice to see, and I still think this thing is trading at a relative discount to its past history with a 5.43% dividend yield. But I think where most of the interest is going to lie in a company like Bank of Nova Scotia, that's probably one of the highest yielding banks right now at damn near over 6%. This thing posted earnings and it dropped 5% today. It's down quite a little bit here. Year to date, it's kind of giving up all the gains that we've seen. On the 5-year, we're down 14%. It's like stepping back in a time machine. And historically, anytime Bank of Nova Scotia has dipped, which historically is only maybe a handful of times through a decade, it's proven to always being a buying opportunity, right? And we also had BMO, which I want to discuss, that actually posted better earnings than Bank of Nova Scotia and is actually having a better 5-year performance, currently paying a 4.43% dividend. Now, for those of you that don't know, Bank of Nova Scotia is the bank that I primarily use for my personal banking. When I'm showing you my tax-free savings account here, this is the back end of the trading platform with Scotia iTrade, and I get my bank exposure through VDY, this ETF here that has over 50% exposure to the Canadian banks and is a monthly paying ETF. But I could also recommend this incredible bank ETF. ZEB is the ticker, the BMO Equal Weight Bank Index. And if we scroll down, guys, firstly, the expense ratio is pretty low. I noticed they didn't update this correctly on Yahoo Finance, so I may have misquoted that in the past because the expense ratio is only 0.25%. The dividend is 4.54%, and it pays that monthly, which is a very healthy yield. And this just immediately gives you the equal weight to all the big banks in Canada: National Bank, Royal Bank, TD, BMO, Canadian Imperial, and then of course Bank of Nova Scotia. If you don't want to buy them independently, but you could also just buy them independently. We're kind of a monopolistic country here in Canada. There's only a handful of major companies in each sector. So I do love the banking sector. It's world renowned for quite a few reasons. And Bank of Nova Scotia's dividend, however, again, taking a look at the long history from a yield standpoint, is at a historical high. The last time we saw yields this high was during the pandemic period. So this to me is something that you could use as a precursor to a buying opportunity. If you believe in a company's long-term trajectory, anytime you see the yield go up to historical highs just on the chart, it's probably a good time to be cost averaging, right? And from a payout standpoint, their dividend is still relatively safe. Their payout ratio is only 50%, and all their earnings are still able to cover that dividend well within means. So there's no problem with Bank of Nova Scotia. However, in comparison to, say, TD or Royal Bank, it's not doubling the dividend as fast. But again, keep in mind, you're starting with a much higher yield, so you could just reinvest the dividend. You still get great returns. But 10 years ago, it was paying 60 cents. Today, Bank of Nova Scotia is paying around $1.03. Now, on this last earnings, we're also getting a little bit of a bonus benefit. It's kind of just the CEO saying, hey, like, we need better performance here. So in the meantime, if you're reinvesting the dividend, they're going to give you upwards of a 2% discount on the share reinvestment plan, which is super awesome. So you get an immediate 2% discount, giving you a slightly higher yield. Reinvesting, a beautiful little system that most people are unaware of that you can get with some DRIP investments, which is dividend reinvestment plans. But let's talk about the earnings, what I'm seeing here, and why my thesis is kind of playing out, because I believe we're in the eye of a storm, and I think that's what's giving discount to bank stocks. And when we get to the other side of this, they're going to print money from the higher interest rated environment. Now, just reading into the last little highlights here, Canadian banking delivered adjusted earnings of just over $1 billion for this quarter, benefiting from margin expansion and strong asset and deposit growth, specifically in business lending and personal deposits. Results were negatively impacted by higher provisions for credit losses, and we're going to talk about the credit losses because that's where most of the pain is coming from. But international banking generated adjusted earnings of just over $600 million, up 20%, driven by higher net interest income as loans grew 19% and strong non-interest revenues. This, combined with continued expense management and lower income taxes, more than offset higher provisions for credit losses. So this is something that's very prudent here because they're starting to see higher income from the interest raised environment. And just taking a deeper look into this from the credit loss provision side of it, because as loans become a little bit more dodgy, as you know, the safety of those loans decrease as interest rates go up and the payments need to be a lot higher, they have to set aside more money at the risk that those default. And that's where a lot of the pain in this balance sheet's coming from, because the provision for credit losses was $638 million compared to just $222 million the year prior, which was an increase of $416 million. So this is something we're just going to keep seeing across all the banks. But there's something really intriguing here, because if we just pay attention to the revenue standpoint, which is something that I think is prudent to just look at before we break down all the expenditures. Their actual year over year, there was only a 1% change, but a 5% change in quarter over quarter. So they actually grew quarter over quarter, and I think they were down 1% year over year to 7.98 billion. So the company is still making an astounding amount of money. Like, their revenues are still in a really stable place. The dividend is still well affordable. And if there's one thing you want to really look at, is that the revenues just on the Canadian banking side were up 10% thanks to net interest income. So my primary thesis here is, after we shake out the bad loans, because obviously there's going to be a higher default rate, so they're going to have credit losses put aside for that percentage that they're predicting out here. Once we get through that, all those bad loans get wiped out. There's still going to be a ton of people getting new mortgages, new business loans, new Canadian banking and line of credits, and those people that can afford those higher rates are going to continue to drive growth on the interest income, which is exactly what we're seeing just on the Canadian banking side. So in a place of stability where they're not putting hundreds of millions of dollars aside each quarter to deal with loan losses, all of a sudden this net interest income that keeps going up is really going to hit their bottom line. And when we get to that point on the other side of the storm, I really think these bank stocks are going to benefit from that. Again, this is not financial advice. I'm not telling you to go buy these bank stocks. It's just my personal prediction, which is why I keep about 30% of my entire sector exposure, which is quite concentrated in the financial banking sector, because I think this is just an easy buying opportunity. So I like getting the fact that my index funds like VDY can do that for me, pay me monthly, and I don't have to worry about managing it or paying too much attention. Now, from the CEO, he said, "We have not delivered the level of total shareholder return that our shareholders should expect of us." Now, he said that the bank aims to have a formal strategy update out by the end of the calendar year, but that key areas of focus ahead are boosting its capital ratio to 12% and better matching loans with growth deposits. Now, as part of boosting its capital ratio, the bank has introduced a 2% discount for its shareholders, adding to their holdings through its dividend reinvestment program, as most other banks pretty much already have. So reinvesting in bank stocks, if you own them individually, you're already getting an immediate 2% return, which is super awesome. But to help boost deposits, Thomas said that the bank would be looking at how it rewards and incentivizes employees and how it engages with customers. This journey will take some time and will require a shift in orientation from the way we reward our people to how we collaborate among our business lines, to how we allocate our capital to customers and segments. So this is just something I feel like all the banks have to do. They really have to look for new growth metrics, and it's all kind of just skewed by loan loss provisions. So I feel like he might just be saying this at the time that we're currently living in. And just taking a look at Bank of Montreal, I'm just going to quickly highlight here because they actually met analyst expectations. They actually reported quite a bit, almost 2.5% higher than what people were expecting, but the revenues were down quite a bit more than Bank of Nova Scotia's were. So the revenue was down 11.8%, but all these banks are falling in that very similar line because provision for credit losses were $217 million compared with the recovery of the provisions for credit losses of $99 million. They're all increasing loan loss provisions. It's going to be the same story from every single bank moving forward. So it's something that you just have to keep in mind and pray, hope that all the bank stocks continue to come down in price. Because again, if you just cost average in these suckers, I'm telling you, baby, this is going to have a really intriguing comeback, I think, in the next 1 to 3 years. We get to 2024, and I think we're going to start seeing some highlights here. Obviously, it's kind of speculative in nature, but you get to go back to the old school Kevin O'Leary thinking of investing, right? Get paid while you wait for asset and capital appreciation. That's what you want to see out of your stock investments, right? And that way you don't have to deal with the volatility of growth, but I still think you're going to get some good growth in this current environment if you're investing today. But again, not financial advice, my personal opinions, but I'd love to know yours in that comment section below.